Hi, I'm Mike Chesworth from Starts at 60. A lot of you today, or a lot of us today, are in a situation where you look at your home and the equity in the home is probably worth a lot more than what you would have thought a number of years ago. And a lot of people who are retired or in their 50s and 60s are starting to look at their I suppose, wealth that they didn't realise they had, and want to be in a situation where they can help their kids maybe get into the property market. And there's a whole lot of different ways they can do that. And I'm here today with Rob Lockhart from Westpac, and we're going to talk about mortgage guarantors. So Rob, to start off with, that's a bit complex. So can you explain in layman's terms how a mortgage guarantor works?
Okay, basically what happens is your child is going out to buy a home. Normally when the bank lends money to someone, they ask you to put in 20% of the money, and the bank will put in 80%. But if you haven't saved up 20%, the bank may still lend you some money, but they're going to put in place what's called lender's mortgage insurance. And lender's mortgage insurance is expensive, right? And it's all about making sure the bank doesn't lose money at the end of the day. Yep. So what you can do instead of taking out the lender's mortgage insurance, the parent could go guarantor, so basically put up their equity in their house to cover off the deposit shortfall they have. So your child doesn't have to pay the lender's mortgage insurance. So it's basically you're saying, if my child doesn't pay that money back, you'll make up the difference.
And I suppose the good bit is they're getting into a home.
Yes.
The pitfall is that you've really got to think about this decision you're going to make to put your home up as collateral for somebody else's loan.
Yes, because if the child doesn't make the repayments on the loan, right, or for whatever reason gets into financial difficulty, right, the bank may end up having to sell that home, right? And if there's a shortfall in what's owed to the bank, right, as guarantor, they're going to come to you and say, can you pay out that shortfall, right, up to the limit that you put on just on your guarantee to start with. But they're going to say, how much can you, pay us? And if you don't have the money, we're actually going to ask you to sell your home to pay that out. So this is why you've really got to think hard and fast about going guarantor.
So there's some benefits to it, especially if you really want your kids to get on that I suppose property ladder and to start them off.
Oh, definitely.
But there's some real risks attached to it. You mentioned quickly then the limitation. So I can put a limit on my mortgage guarantor to I suppose lessen that risk.
Yeah, so what you do is you go, the bank is happy to lend the money up to 80% if the child has the income to pay off the loan. So you just limit your guarantee, how much you'll put in, up to that deposit they didn't come up with. Right, to bring them back to that 80% so they don't have to pay lender's mortgage insurance. And that is all you're up for.
And how long does your mortgage guarantor stay in place?
Generally what we do is we set it up so as the child starts to pay the house down, when it gets down to that 80% level, usually you'll be able to take your guarantee out.
And they can do this not only for the property market, but they can also, if someone's wanting to get into small business or whatever, you could actually help them in that way as well.
You could help them that way as well, but let me say,
the risk
goes up with business.
Right. So there is ways, so if I sit there and I do know that I've got equity in my home and I do know my children are wanting to get into the property market, especially in the capital cities, it's really difficult at the moment. Actually, it's difficult everywhere for them. So to be able to give them that helping hand, it's a good way to go, but you've got to go in with eyes wide open.
Eyes wide open, right? What you want to make sure is your child has a regular income that can repay that, right? That absolute must up front.
Just one last question, Rob, and this is always a dicey question. If there's a separation with the children, if it was a husband and wife going into this and it was mortgage guarantor, can you dissolve it?
No. So basically, if they get separated, depends what happens to their loan and the property.
Right.
Okay. So if they sell the property off and pay back the loan, your guarantee's gone. Okay. But if they if there's still a shortfall, you're still on it. Yeah.
Okay. So they're the things people have got to go into. So there's some real benefits to do it, to help people
Yeah.
on their way.
Oh, definitely.
But there's some risks that people are going to be aware of when we're going to sign something up.
Definitely.
That's great.